Hello and welcome to the Mutual Fund Show. My name is Niraj Shah, and it's not too often that we we talk in details with a guest who may or may not have a particular product within their category as well, but believe it's important to come out and talk about it. And that is what our guest today is doing. Ajit Menon of PGIM is joining in today. They've done a survey which gives some pretty interesting revelations about how India plans for its retirement. And on the back of that, what is it that you, me, and everybody else should be doing in order to make sure that our retirement is secure via the use of mutual funds? He joins in right now to talk about that. Ajit, good having you. Thanks so much for joining in. Hope all is safe.
Thank you, Niraj. All safe, and I hope likewise.
Yeah, likewise, indeed. Touch wood. So far, so good. Okay, before we get into the crux of how people should be doing it, you making the use of mutual funds, since this is a mutual fund show. Tell us.
Sure.
I mean, it's an interesting survey that you've done. What were the standout learnings out of this survey that you did, and why did you do it in the first place?
So very quickly, PGIM, Prudential Global Investment Managers, part of Prudential Financial of the US, which is technically currently the largest multinational mutual fund brand in India. It manages about $1.89 trillion of funds, with PGIM, the asset management business, managing about $1.4 trillion. What's important is that Prudential is also one of the largest asset managers for pension funds around the world. So retirement came naturally to us, including here in PGIM India. I think the context that we wanted to set, Niraj, was that this is an all-important life goal, which we have known traditionally that people sort of push to the background. And our survey wanted to find out the reasons for those and where people are getting stuck. Just let me give you one very interesting perspective that I share with clients and advisors. Did you realize that retirement is the only financial goal in your life for which you don't get a loan? You might think about children's education, marriage, house, car, starting a business. You can get a loan for all of that. The only thing you don't get a loan for is retirement, other than maybe a reverse mortgage or something like that. So it is very important as a goal. And our survey found that the attitude towards retirement is shifting, Niraj. In the cities, which is what our survey is largely more urban, about 8 metros and 7 mini metros, very representative of Indians all across those cities, is that people are worried that they're going to be dependent on their children. They don't want to. But 51% of people who hadn't planned for their retirement, 55% of that 51 said, we don't want to retire. They feel that they'll work forever. Younger generation, they feel that they are in business. They have multiple skills. They don't need to hang up their boots on a certain date. There's a lot of danger in this, which is what I'd like to highlight from what we learned from our survey. Couple of things. One is that people don't account for these kind of eventualities that might happen, say, towards health and your income stream actually breaking down. People don't look at alternate income streams, for instance. And 90% of the people we surveyed don't take inflation into consideration when they're planning for their long-term goals. So you put all this together and you've got a pretty tight situation coming up for a lot of people as they near closer to when they want to do something passionate and hang up their primary source of income.
The other interesting thing that I think your survey also threw up, and please correct me if I'm wrong, is that fewer people in the lower income or lower salaried bracket thought of retirement plans, wherein maybe, just maybe, that's the bucket that probably needs to save a larger proportion of their income in order to have a decent retirement. Would that be a fair assessment?
I think this is a perfect assessment, Niraj. In fact, one of the biggest insights that we've had in this retirement survey is planning for long-term goals like retirement is not incumbent on age. It is incumbent on your income. And people only start putting away money for goals like retirement once they have a surplus after taking care of all the other expenses and their other priorities, which is largely related to children's security, spouses' security. And of course, our survey found that with Nielsen, our partner, who had done a similar survey about in 2017, that new goals are coming up for Indians. Financial security seems to be going down the order of priority, and things like having a comfortable lifestyle, staying fit, Those are things that are coming up in priority even earlier than goals like retirement. But you're right that it is income that's a bigger determinant of planning for these long-term goals rather than age.
But I can relate to the staying fit part for sure, and maybe that is
Yeah.
probably really really important. But hey, viewers, I would love to tell you. I mean, we the importance of or the point that some of you will make that when the income is low, you anyways don't have disposable income to plan for retirement because the daily needs take up a lot of money. This is not a
Right.
personal finance show, so I'm not gonna get into the merits
Mm.
of that.
True.
But what I'm trying to get into the merits of is that if you believe that planning for retirement is really important and India as a nation is not doing it, how can mutual funds help you do it? And that is what we would now request our guests to try and tell us as to what's the best mode via the mutual fund route for people to plan for their retirement. And uh, uh, any thoughts about what kind of age is an ideal one for starting to do this via the mutual fund route, Ajit? So two questions rolled into one.
So, to answer your second question first, the earlier the better. I think that has been said again and again across all media by experts that the earlier the better, because you let compounding work in your favor and you can take care of inflation as well. But as far as mutual funds are concerned and using that for planning for your retirement is concerned, Neeraj, you're absolutely right. I would say that mutual funds is a perfect category to look at while planning for retirement for a couple of reasons. And I'll also speak about the category within mutual funds, which I believe is a great category for people to start with. Why mutual funds? Because we all know that diversification, or not putting all your eggs in one basket, is the most fundamental mantra for a good experience with your investments. And mutual funds allow you diversification, it allows you transparency, it allows you convenience. So as a category compared to many other categories, this is right up there, very tightly regulated by SEBI as well. So you can trust the category. Within that category, I would think that I personally like the category of the balanced advantage funds for any investor to start their journey towards long-term investments. And I would say that not just balanced advantage fund as a category, because there are other asset allocation categories available, but this what I would put as the primary one. There are other things with mutual funds, which is things like the convenience of doing an SIP, and similarly, like doing an SWP, a withdrawal, or for that matter, things like a top-up SIP, which not too many people are aware of. These are little strategies that mutual funds allow you to do, and if you can bundle that with the category of balanced advantage funds, that would be a great starting point for you to be investing for your longer-term goals.
So it's not just because Dhoni is saying so. Ajit is laying out really important points of why. Ajit, the importance of we'll get to the other parts that you mentioned, which is the top ups or top up SIP or the SWP in a bit. But just your basic mantra of why you are saying that balance advantage as a category is the best or one of the better categories to invest in from a retirement planning perspective.
Uh, the balanced advantage fund category, according to me, is one of the best categories to think about when you're looking at planning for things like retirement, for the simple reason that first, it has asset allocation built into it. It is something that is timeless in terms of achieving a good outcome with your investments, and this is one category that has it automatically built into it. The second is that it builds you discipline. Everybody says that you need to balance your asset allocation through up and down market cycles. The balanced advantage fund category is the one category in mutual funds where they run by different kinds of maybe internal formulae, whether it is related to PE or PB or yield, bond yields, and it automatically resets the equity and fixed income allocation in this. So it helps you build that discipline. Third is that everybody wants better downside protection. And I can tell you that this is one category that helps you definitely build that downside protection. Fourth, I would say that, a lot of people chase returns, and we know that that's not a great thing to do. I think when you look at investors internationally in more developed and more matured markets, they will always tell you, look at returns per unit of risk that you're taking with your investments. Balanced advantage funds allow you to get a better return per unit of risk that you're taking in your exposures. And lastly, I would say that it's a tax optimized category as well. Rather than you trying to do it with one equity and one fixed income and moving in and out, this is a category that's designed so that you have your tax benefit, equity like tax benefit, already embedded in the product. So I would say those are the 4 or 5 reasons that I feel this category is appropriate.
Can I ask you, why do you say that it's the best bang for the buck that the BAF category provides? Why do you say that vis-a-vis some of the other options?
So, it's about what is the kind of returns that you would need for, say, fulfilling your goals, right? You would typically look at something that is keeping pace with inflation, beating taxes. So that's the kind of returns that you want from a category. Now, while I'm not going to talk about what overall returns have been or so, I'll just give you rough examples. Say, for instance, in the year 2010, the Nifty TRI index would have given roughly a return of about 18%, when this category gave a return of 16%. Not bad returns, but somebody would argue, hey, it's lower than having invested in equity. In the very next year, the Nifty TRI index was down 24%, and this category was down only 14%. So when you think about downside protection because of the embedded asset allocation, this gives you decent returns that are good enough to meet your financial goals over the time frame, and it also gives you good downside protection in years that are bad. And just talking about bad years and the year 2020, if you were to look at the calendar year 2020 as well, the Nifty TRI index would be negative, whereas this fund or this category is, well, it's not given any great returns to write home about, but it's not negative, it's positive as a category. And I think a lot of people would like to see that. They don't like to see their capital deteriorate, and over periods of time, therefore, take advantage of this asset allocation that's embedded in it. That's what I meant, Niraj.
Okay. Before we get to whether you guys have something in this category also or no, sorry, can I ask you, for a young person like yourself, or even a younger person who may be 20, Ajit,
Right.
are there specific routes that you would adopt while investing in a balance advantage category, say a SIP with a top up, or a normal SIP, or in some other way? So just so that I'm taking an average, so that people of all age groups, or largely the all age investable groups, get a sense of how to best approach investing in a BAF with a retirement horizon in mind. So from a perspective of somebody who's 20 or 25 or 30 and has 30 years of
Right.
retirement, you are advocating starting investing in a BAF right now and keeping on for 30 years, is it?
Right. Yeah. So I would say that, because the category's got embedded asset allocation, you need not worry too much because it will do the auto balancing for you. It's almost like a fill it, shut it, forget it kind of an option available within the mutual fund industry. So that's why I would recommend it. It's easy to keep track of. But just to look at the specific example, Neeraj, that you're asking me for, and I spoke a little earlier about certain little tricks with mutual funds where, you have things like SIPs, STPs, SWPs, and something like the top-up SIP that most of the mutual funds allow. How can a young person use this while investing with mutual funds and the balanced advantage category for retirement? So let me give you this example. Assume that you're talking about a 30-year-old, somebody who's looking at hanging up his or her boots by, let's say, 60. Assume that this person has a 25,000 rupees expense on a monthly basis. That's a 3 lakh rupee expense a year. I'm taking 25,000 because I want to try and reach as many large retail investors and viewers as possible when they think about that example. So a 3 lakh rupees expense a year. One of the things our survey said is that 90% of people don't look at inflation when they look at their long-term goals. And for our survey, where the average income was about 5.5 lakhs, people felt that 8 or 9 times that, or maybe a 50 lakh corpus, is good enough. And that's dangerous. It's not good enough. So let's take this 30-year-old example. 3 lakh rupees expense a year. Your expenses, thumb rule based, would probably double every 10 years, given the inflation that we have in India currently. And there are other tricks to that. Let's not get into the rule of 72 and all of that. Just assume that your expenses will double. So 30-year-old with 3 lakh rupee expense at 40 years, that's 6 lakhs. At 50 years, that's 12 lakhs. And at 60 years, that's 24 lakhs. Now, any expert that helps you plan for retirement will tell you that you need at least 30 times your annual expense to be your retirement corpus. That's the way to think about it. Okay. 30 times your annual expense at retirement should be your target corpus. At 48 lakh rupees at the age of 60 for a 30-year-old today, he needs a 7.2 crore retirement corpus. Now, for somebody who's spending, or 25,000 rupees a month, they'll think, what the hell? I mean, how am I going to even reach there? Half the time people don't plan for retirement according to a survey because they don't know the number and how to compute it, right? Now, here is the trick. The SIP that 30-year-old person might need to do to reach that 7.2 crore corpus, assuming a 10% kind of return, is 30,000 rupees per month as an SIP. Now, if you tell somebody that, they're going to jump out of the window and say, stop this nonsense. There's no way I'm going to be, when I'm spending 25,000 rupees a year, why are you asking me to do this? But when you use the top-up SIP facility, which essentially is start small and automatically increase your SIP by, say, 10% every year, right? And you can do that because your incomes are rising year on year as you go through your career. Now, for a top-up SIP, all you need is about 11,000-ish rupees to achieve that same 7.2 crore corpus, right? So instead of 30,000 rupees a month, just using the top-up SIP facility and looking at a beautiful category like Balanced Advantage Fund, 10 to 11,000 rupees a month, and you're home. Maybe you can reduce that even further in case you already have some savings built with you or some other property, inheritance, PF, and things like that you already have. My advice is always to go to a good advisor, trusted advisor, and figure out what your retirement number is. But I think this is key to, just for your example of how a person who's 30-year-old can plan for something like this using the Balanced Advantage Fund.
Okay, so if you're 30 or thereabouts, 7.2 crore retirement corpus, start off with 11,000 in a Balanced Advantage Fund category, a fund that your advisor would advise you, and have a top-up SIP plan, and maybe, just maybe, or not maybe really, a very high probability according to Ajit's calculations that you will reach that goal. So doesn't sound too daunting. Just wondering. So multiple balance. Yeah, that's the whole idea. Yes, there will be multiple balance advantage funds viewers. So I mean, in today's show, we're not going to talk about which is a good fund or which is a bad fund. For that, maybe we'll do a show with advisors, and enough shows done in the past to tell you also enough areas where you can go and research. But Ajit, may I ask you before we kind of wrap up the show, are there options within your house your fund house wherein there is a balanced advantage category, and what's the kind of returns that one should expect from such a category?
Niraj, rather than going into returns, we do not have a Balanced Advantage Fund at this point of time, and we intend to launch a Balanced Advantage Fund shortly. What we do have are certain investment facilities and solutions, which we call the Dynamic Asset Allocation Facility, for instance, and also an age-linked asset allocation facility. Both of these are good solutions for investors that we offer. What we intend to do is to embed the Dynamic Asset Allocation Facilities algorithm within our Balanced Advantage Fund when we launch it. This has been a live facility with us for quite some time. There are many live portfolios on it. All I can tell you is that even if I look at a 10-year horizon for this particular product or this facility, if the Nifty TRI has been about 6.5% in that time frame, this facility has given a low double-digit return in its history. As a product, what we have done is now the default in this facility is our diversified equity fund and the bank PSU debt fund within this facility. But more than the facility, I would say, to also make it better tax optimized, we intend to put this algorithm into the Balanced Advantage Fund, which we will intend to launch pretty shortly.
Well, okay, we will wish you all the best for that. One final question, Ajit, and that is, so one is a category which is not necessarily branded as a retirement category, but you believe it's the best one. There is also a branded retirement category within the mutual fund universe, right? What's that all about? And why do you think that the Balanced Advantage category is better than the one which is branded as the retirement category?
Well, the category that is currently branded as retirement, and SEBI is allowed for this category. The difference is that while this is a full long only, equity product, it has a 5-year lock-in for the investor when he comes in. After the first 5 years, then you can step out of the fund. So that it is just about promoting people to stay long term and experience the benefits of equity investing. For the whole mutual fund industry today, Neeraj, as you know, the average age is under 3 years. So people are moving in and out of this. And I think this 5-year lock-in is a good feature for the retirement fund. But a good advisor will tell you don't need a fund called retirement to do this. And to me, I think the fundamental principle of asset allocation and automatically gaining that within a balanced advantage fund category is an easier, simpler, as I mentioned earlier, a fill it, shut it, forget it kind of option for investors to probably use. So that's what I would think is good. And much of these retirement fund category products, I mean, since they are 100% equity funds, they're more suitable for younger investors who are in the savings phase of their life, not in the distribution phase of their lives. Whereas an asset allocation product actually suits on both sides.
Yeah. Okay. Fair call. Well, thank you so much for joining us and giving us this small perspective. The math was wonderful. And yeah, the survey threw up some interesting trends. So thanks for that as well.
My pleasure, Neeraj. Thank you so much.
The pleasure was ours to have you. And viewers, that's the long and short of it. So retirement planning in a personal finance side is important through the mutual fund route. PGIM believes that the balance advantage method might be a really good way to do it. And even if you don't have very high incomes right now, but progressively as your incomes will increase, maybe having a progressive SIP or a top-up SIP might be a good way to do it as well. Thanks so much for tuning in this leg of the mutual